Hello dear traders, I'm Anna Kasatkina. Welcome to Insta TV. Investors are totally confused about a non-stop slump in global oil prices. At the OPEC meeting in December, oil exporters failed to reach an accord on how to handle the oil glut. Since the last meeting, crude prices have tumbled almost 15%. When output goes up, demand goes down in line with the common practice. The cartel of major oil exporters made the situation worse with its decision to keep the current quota of the oil output. Today in the Asian session, February Brent futures were trading at $37.86 a barrel. Later, the price edged up to $38.62. For how long? Analysts note that global price benchmark Brent has sunk about 34% in 2015, as the oversupply to the oil market is pushing oil prices down during the whole year. Meanwhile, WTI rebounded on the New York Mercantile Exchange, but it discouraged investors with minor growth. WTI is trading at $36.05 a barrel. This year, North American crude plummeted 32% on the back of redundant oil output. Today, market participants are awaiting a new weekly report on oil inventories. Amid the adverse situation in the crude market, a lot of traders are considering whether to change a trading instrument. Moreover, the U.S. Federal Reserve is to make a crucial decision on the key interest rate. A few words about commodity currencies. Oil is still putting pressure on the Canadian dollar, which is losing ground against the US dollar. In the European pre-market session, investors opted for the US dollar in the dollar versus the Canadian dollar pair. Meanwhile, the currency pair is trading at 1.3686. The US dollar is expected to strengthen further after the release of the US inflation report. Experts warn that tumbling oil prices could trigger the aftermath to the Canadian economy and a key interest rate cut. Today, markets are anticipating the manufacturing sales report and a speech of Bank of Canada Governor Stephen Pawlers. The policymaker can make precise comments on the state of affairs of the Canadian economy. In addition, a slump in oil prices is making a negative impact on the Russian ruble. The adverse situation in the oil market is likely to affect badly Russia's annual public budget deficit, which could account for 3.5% of GDP. A lot of experts predict that Russia's economy could plunge into deep recession, so public spending will have to be curtailed. The country will be able to exit from austerity in case oil prices surge to $60 a barrel. Commodity strategists think that the oil market has not reached the expected bottom yet. Now producers are in a hurry to sell as much as possible at current prices until they fall in value even lower. This was Daily Financial News on Insta TV. See you back soon. Bye.